Politics and tariff mania are making markets and consumers nervous. Some markets are up and some are down, but diversification is helping a lot. Volatility is overdue and more normal than people think, and some markets are strong. That and more in today's quarterly context presentation. This is the first quarter's presentation of quarterly context for 2025 for clients and friends of the advisor group. I'm Greg Patterson, CEO. For those not familiar with the advisor group, we are a wealth and life strategy firm focused on helping business owners and leaders and others with their financial goals in their personal and family realms, their fiduciary employee support efforts and retirement plans, and their communities through foundations and endowments. To complement the strategic goal and financial work we do with clients, quarterly context webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, investor behavior patterns to help personal wealth, endowment, and 401k fiduciary clients stay more relaxed and make better decisions by being more informed to help your goals. This quarter, we're going to have an extra segment on market volatility, given that everything's pretty bumpy out there lately, and we'll try to keep this to 25 minutes or so, and then we'll circulate a video link should you like to view some part of it again or pass it on to someone you think we can help like we've helped you. And if you have any questions, please submit them into the question box. So as mentioned, we're going to cover a number of topics, patterns that matter as always, the tariff trouble, an updated recession risk scenarios, and that volatility focus that I mentioned, in addition to a number of normal topics. And maybe more than ever, this slide, or anytime there's significant volatility, this slide is a great reminder of where to focus. You can't control markets. You can control your strategic design and sticking with it and riding out those difficult markets to improve your long-term outcomes. The advisory group is always focused on doing the right thing for our clients. Clients always come first, and that is a core part of our philosophy and culture. There are always headlines that cause the market to bump around a bit. There was a tech shock, in particular NVIDIA, when China's DeepSeek came out with a new low-cost tool. The Fed stayed steady on rates given concerns about inflation still. The tariff talk began and then picked up and accelerated and magnified. Inflation heated up a little bit, but then normalized a bit. But that inflation concern also reinforced the Fed's stance of staying steady. Stocks later took a pretty significant tumble towards the beginning of March when the tariff talk sparked retaliation from other countries. Tech stocks in particular, but some others suffered as a result. And the Fed started talking about a lower economic outcome, and the more and more people talking about the increased chance of recession. And the quarter ended up with the worst quarter since 2022, primarily around the threat of the trade war. So rates stayed steady after 3 cuts in 2024 and 11 hikes in a couple of years before that. Inflation has been relatively tame, but there's concern that it may pick up speed with the tariffs, but currently or recently at 2.4% instead of the 9.1% peak of June of 2022. Market returns, the overall US market was down 4% versus the bond market up 2.7%. International stocks were up higher as well, actually positive. And there was a big difference between large cap value and large cap growth stocks, for example, with large cap value actually being positive 1.6% and large cap growth being down 10%. Unemployment right about the same at 4.2%. and GDP has some interesting numbers. The fourth quarter update was 2.4% versus the prior quarter at 3.1, so a little bit of cooling there. And then the Fed has different offices, and the Atlanta Fed created an updated model to remove gold imports, which they thought were skewing the numbers, and that turned out to produce a predicted negative 0.5% growth for annualized starting the first quarter of 2025. So that's a predicted number, whereas the traditional model out of Philadelphia is closer to the current 2.4%. So that is a big difference, and it'll be interesting to see what happens. Of course, the biggest talk and concern out there, both consumers and businesses and countries globally, are the US tariffs. And some are wondering if this is a highly skilled three-dimensional game of chess that will have a surprisingly positive outcome, or is it really short-sighted, poorly played game that may end up doing damage to the economy and international relationships. That's too early to tell, but the market is certainly leaning towards the latter with the way it's pricing in cooler prices in the US. So I'm going to walk through this a little bit more than I would normally walk through a text-heavy slide, but there's a lot of information that a lot of people are asking us questions about. I want to make sure this all comes through. So tariffs are essentially taxes, and more often than not in the past, both the implementer and the recipient of the tariff lose in the past, and can be effective sometimes if the recipient backs down and caves into the demands or just gets sufficiently punished to the point where the implementer backs off. It can be damaging on both sides and have fallout outside of the primary tariff partners if the target tariff fights back, and even more so if there's escalation, and the escalation is happening in some cases. And for example, China is saying that it will fight to the end. And so that doesn't sound like backing down. So that presents a challenge. It can be even more damaging if coalitions form in terms of the long run, and if when and if alternate trade routes stick. There's lots of examples in the past where tariffs have led other countries to find other trading partners and then didn't revert back to the tariff implementer in the future because of either a lack of trust or found better alternatives. Inflation and a slower economy are often the consequence of tariffs, and that increases the chance of stagflation, where inflation is going up and GDP is going down. And unfortunately, the Fed doesn't have tools to fix that because their tools are designed for one or the other, but not both. And the Fed is already struggling to maintain a very careful balance of hoping to lower rates, but not wanting to trigger inflation. And that's even before tariffs became an issue. And this big off and on approach to tariffs makes it complicated in terms of relationships and trust and growth. And some are saying that it makes the US look a bit like a rich third world country, especially when we consider the government shutdown threats that were again averted. But the combination of these two things make the US look like a less reliable trading partner and less reliable political partner for many. And that is the feedback from those countries already. What complicates things further is businesses can't plan, so don't make as many decisions and don't hire or may reduce hiring or have layoffs, and aren't making big commitments to inventories because they don't know if they're going to get in big trouble with financially with tariffs if they don't know what the tariffs are going to be or whether or not those tariffs are going to be there. So that has the effect of slowing down the economy. If decisions are slowed down, the economy slows down. So a belief and trust in the future is a big deal. Even if it's a soft topic, it is a hard impact. And some were thinking, oh, well, these 90-day tariff delays will help the situation. And it did give the market a boost, but it actually makes the overall dynamic worse. At some level, it would be better if the tariffs were defined, stated, implemented, and stuck with, because then everyone can start to plan around it. But if it's off again and on again and off again, then that's even more uncertainty. In the background as well, there's been a sell-off of U.S. government bonds due to a decreasing trust in the U.S. and the dollar, and that can lead to higher debt service rates for the U.S., which can magnify the overall U.S. debt and debt service. So some longer-term implications potential there as well. The idea of tariffs and the hope, at least stated hope, that will increase manufacturing in the U.S. For that to happen, businesses really need to believe that tariffs will stick around long enough for them to invest into capital to restart manufacturing or start new manufacturing plants here. However, it's very likely that if that does happen, if people do decide that business do decide they will be building factories here, there will very likely be a much higher focus on automation, like was the case during COVID, and that may not produce as many jobs as people are hoping. All that said, there are more hints and statements that suggest that this tariff mania is primarily a negotiation tactic. That's hard to tell completely yet, and it may be a negotiation tactic for some and a hard status for others. But in any case, that can damage relationships and the sense of reliability of the U.S. for longstanding partners around the world. That said as well, lower dependency on the U.S. And cutting aid and cutting other foreign programs can decrease the U.S. budget, but it also lowers soft power and influence, which is very important. Other variables that could impact inflation are mass deportations, which could cause a labor shortage, and a less independent Fed if a new Fed chair is put in that will cut rates, which would boost growth, but very likely jack inflation up as a result. And just today, the president made a comment that termination of Chairman Fed Powell can't come fast enough. That would be unprecedented, and also, if that were to happen, very likely lead to a significant market hiccup because markets will be very concerned about that. There are also some policies that could help in the short run. If lower oil prices occur, that can create an economic boost, and lower taxes, although that tends to be a short-term effect and can have other problematic long-term implications in terms of taxes, given especially the overall budget deficit problem that we already have. So let's take a look at what happened in markets. You may be pleasantly surprised to see that there is very little red this quarter. The US was down, which was primarily heavily on the growth side, growth stocks, but down overall almost 5%, whereas international up 6%, emerging markets up 3%, global real estate up 1.5% almost, and the US bond market almost 3%, and global bonds about flat. So not bad, and you'll see later that diversification and blending those things together has led to some pretty tolerable results, at least for the first quarter. Pulling back this slide, something we haven't shown in a while, but this is an environment where higher quality stocks and bonds, but this slide focuses on stocks, have done quite a bit better when there are concerns. The companies with lower debt, higher return on equity, and so forth tend to have better returns. They tend to be more resilient in challenging environments. And so the green here shows segments of the market for the quarter and the year that have done better. Green is higher quality, and the numbers are not the returns, it's the difference between high and low quality. So, for example, small cap growth outperformed, high quality outperformed low quality by 11% for the quarter. That's how to read these charts. So high quality has been a little bit out of favor for a while. This kind of environment, it tends to shine. See what these numbers look like in the broader perspective, going back to the 2007 or so. And this is the dip we're seeing so far as of the end of the quarter, a little bit further since then. But in perspective, you can see here, still not an enormous dip, but we would be surprised if it didn't cool further before it made a comeback. Here, this chart illustrates or is a reminder of the dynamic nature of markets over time. There's been a lot of focus on the Magnificent Seven, of which are part of these top 10 stocks here, but this shows the top 10 stocks by market capitalization in 2024, 2010, 2000, and 1990. And some of these are a little bit smaller part of the indexes now. The Magnificent Seven have suffered in many cases the most in recent months because they have been more affected by the market news and were more overvalued, and as a result have had bigger pullbacks. But the point of this overall chart is that if you look back in 1990, none of these stocks are in the top 10 now. In 2000, only one. In 2010, only one still then. And in the last 15 years or so, things have rearranged a lot. But each year, there are significant shifts in terms of what stays in the 10 markets. In the top 10, markets are cyclical, things evolve, things change. And people who've been enamored by the Magnificent Seven are paying that price now because falling in love with what's hot oftentimes ends up burning you. Diversification and patience are very powerful, and this recent period has been an important reminder of that. Here you can see how the US market here in gold has been on top for a extended period of time, much longer than normal. However, more recently that's reversed. Now the international stocks are on top and the US is towards the bottom of the rankings, as we can see here. So for first quarter, the Mag 7 stocks down 16%, the S&P down 4%, value stocks in the US up 1.6%, international stocks up 7%, and US bonds up almost 3%. So diversification, blending things together, avoids the big drops of any particular segment of the market. So congratulations on those that are diversified, and if you're clients, that is definitely the case. If we take a look at sample 401k portfolios that we build for 401k plans, just because these are sample returns we have ready to look at already. A 100% equity portfolio, because in a diversified portfolio, up 1%. Not an exciting return, but not negative overall. 75% stocks, 25% bonds, up 1.3, 50-50, up 2%, and a heavy bond portfolio with only 25% stocks, up 2.5%, a little more than that. And so all positive across the board due to diversification, despite some significant pullbacks from the major stocks and the overall US market. So diversification, works, and there will be quarters where everything is negative as well, but diversification will still help prevent a bigger downside versus being over concentrated in the most negative segment of the market. So stock valuations, as a result, have cooled a little bit in the U.S. with market cooling. Subsequently, it's cooled a little bit more. The good news is that makes prices more attractive, even if they're still relatively overpriced versus history. So that suggests that there is still room for markets to reasonably cool, but we can't predict when or how much. And here's the current valuations relative to other countries. Other countries and regions, even if they've had some positive returns, are still relatively attractively valued. So we wouldn't be surprised if there is continued benefit from international stocks on the horizon. We showed this slide a couple of times in the last couple of quarters, highlighting the view by one organization that large cap growth stocks could have a 10-year return in the 0 to 2% range. This first quarter, and so far in the second quarter is heading toward that direction, but we still have more than 9 years for that to see what happens. And we would still be surprised if large cap growth returns were this low, but just by having, if returns were this low for a while and averaging out with the prior 10 years, then you would end up with something more like the long-term average, interestingly. So anything's possible, and this is another reason why diversification is so critical. So what really has driven that U.S. market drop so far, primarily the Magnificent Seven. Some are now calling the Lag 7 instead of the Mag 7. Again, diversification, very powerful. These chart tables of returns look a little different than they have in recent quarters because of the boost on the value side and the cooling on the growth side. Still a pretty significant difference, but the differential between value and growth is really shifting, and so that is going to help create more normalization. Here you can see the difference in the year-to-date numbers. Inflation, as mentioned, is remaining relatively tame, but there are concerns about it picking up again. And just a few days ago, there was a consumer survey that showed that there's an expectation that inflation will get back to closer to 7%, and that is the highest number that consumers have estimated since 1981. So that gives you a sense of the level of concern out there, which also affects consumer sentiment, which we'll see later. The Fed, has continued to hold at the 4.25 to 4.5% rate level, and it may hover there for a while unless the Fed chair is replaced. Last quarter, we saw that the market was expecting returns to cool down or stay higher longer than the Fed was projecting, but now the market has actually come closer to the Fed's projections, given what's happening around tariffs and everything else. The bond yield curve has shifted a bit. It went from slightly inverted last quarter to sort of going back a year, significantly inverted. Inverted means that rates are higher at the short end, whereas normally a normal shape curve would have rates that are lower at the shorter maturity end and higher at the long maturity end. Inverted means that the bond market expects a recession or economic cooling of some sort over time. Then there began to be a semi-normalization towards the end of last year as things, the economy looked like it was in pretty good shape, but even if it was slowing a little bit. But now the curve is partially inverted, but more inverted than it was last quarter, showing an increase in concern about the markets and the economy. Also, the 10-year Treasury yield dipped below 4% for the first time since October, which is a sign of concerns about recession. And economists are seeing the trade war as creating higher risk for government bonds. A block of foreign investors are selling U.S. government bonds, which are traditionally seen as the world's safe haven security, but are not currently viewing them as safe as investments that are as safe as they used to be. So that would be harmful in the long run if that is increasingly the stance of foreign investors, because the demand helps the U.S. keeps rates low, which keeps debt service for the U.S. low. And if that reverses, that becomes more expensive, and the U.S. loses both economic and political power. So what are the probabilities of recessions? Some organizations are projecting that the probability is going up. JP Morgan is estimating now 60%, whereas last quarter it was lower than 50%, sort of in the 40 to 50% range, depending on a couple of scenarios. So the chance is going up, given all of the tariff dynamics, international politics, and everything else. Unemployment numbers have, as mentioned before, have hovered around the same level. Wage growth is staying about similar. Consumer confidence took a dive at the end of March, down to the index down to 57, and subsequently, just 2 weeks later, fell all the way to a level of 51. And that is a level that hasn't been seen in quite a while, going back to the early 80s or so. Consumers are concerned about whether or not they'll be able to get a job, keep a job, and the likelihood of inflation, and so forth. And then less confident about housing prices, or their ability to buy, and what the impact is already and in the future on their stocks in their retirement holdings. So let's talk about volatility. A few slides with special focus there. Politics do impact volatility in some cases, as is the case. We see volatility numbers, political volatility and economic volatility are up significantly to a relatively historically high level. Historically, political decisions are smoothed out over time and are temporary. That is likely to be the case in the long run as well here, but we'll see how stubborn the policies are and to what degree they are a negotiation tactic versus an actual trade policy. Volatility is a lot more normal than a lot of people think as well. There's typically a 5% drop about twice a year, a 10% drop about every year and a half, a 15% drop every 3 years, and a 20% drop or more once about every 6 years. And you can see here how long the length of that drop lasted. So 46 days, 135 days, 256 days, 402 days. So the more it drops, the more the length of that drop, the longer that length of that drop is, and sometimes the recovery takes longer in those cases as well. And all of those most recent cases happened back between now and early 2022. So it's normal, and it will always be normal. It's just a matter of when it happens and how long and how deep, and that's unfortunately not predictable. But by looking at history, you can also see that while there are some pretty big dips, for the most part, almost always the dips are a lot more shallow than the highs are high and last a lot less longer than market rises. So the red here shows the market dips, sometimes steep, but generally relatively short. And the turquoise shows the market longer patterns of rise. And that will be the case in the future as well. We just can't tell you exactly when and how much. But seeing that how normal that is in the past can sometimes be helpful. It's also important to remember that while there may be a psychological tendency of the brain to be concerned and take action, which is important in some situations, it's oftentimes harmful when it comes to finances and in particular stock markets. So being an emotional investor often does a lot of damage to your wealth in the long run, and sticking with it, even if it's uncomfortable in the short run, is a powerful strategy that tends to work much more effectively in the long run than trying to guess the market or getting out and waiting for it to recover. Because if you get out, it's already gone down. You wait for it to recover, then you miss the recovery. And getting in and out requires two perfect decisions: when to get out and when to get back in. So this chart shows the impact of being out of the market over about 20 years. And for someone who was fully invested and just stuck with it, ended up with a 10% return. For someone who missed just the 10 best days, about more than 4% less than that, 6.1%. Missed the best 20 days, it's only a 3.5% return, and et cetera, down to missing the best 60 days out of 20 years. You actually lose money, almost 4%. So the key message here is that that you can't guess when it's going to happen. And if you look at the numbers, the market bounce backs, the biggest days tend to happen shortly after the worst days. And so right when people are at their most nervous is right when some of the best days tend to happen. So you don't want to miss that upside. You got to be in it to win it, even if it is negative sometimes. These kinds of markets are a great reminder of the importance of bonds. If you are a very young investor or particularly aggressive and don't hold bonds, then you should have a time horizon that's long enough to ride that out. But those that where bonds do make sense, which is most people for most ages, or a lot of ages, while bonds seem boring sometimes, and even if bonds had a negative return during a couple of years ago in 2022, particularly when rates were going up, which pushes bond prices down, the Fed was pushing rates up to try and rein in inflation. That pushed bond returns down temporarily. And some people thought, well, why am I in bonds if they're negative? Because they're supposed to be a cushion. Well, that's one of the very few environments where bonds have more significant cooling, but still nowhere near the cooling of stocks. But now with stocks cooling in a non-interest rate rising environment and a more normal environment, bonds are providing a very helpful cushion. Year to date, as of this chart, essentially offsetting the 3% of bonds is offsetting the negative 3% of US stocks. So bonds are a powerful tool. This is a great reminder of why diversification and discipline matters. This chart shows similar information in a different way. Also a little bit different, shows the S&P through the middle and then stacks other major asset classes above it or below it, depending on what outperformed or underperformed. You can see the US is hovering towards the top for the most of the last 10 years, but 3 years ago, and this 2025 so far, you can see the US is towards the bottom, a balanced fund above that, bonds above that, emerging market stocks above that, and international at the very top. So a great reminder that even though international and emerging markets have been hovering near the bottom for a while, it is coming back in favor for a combination of reasons, and is very valuable as a diversification component. This chart shows what the typical sort of array, not typical, but historical array of market coolings has been, and the typical patterns of the bounce backs. So, and here it shows the number of days to get to the bottom and the number of days to get back to where markets were originally. And this may just be helpful to see how common it is to have coolings and how the shape of recoveries is different, but the shape of recoveries are significant. And if you miss the recovery, that's really the only way you end up locking in your losses. And it's really easy to forget about the recoveries when you're nervous and you're in the middle of a cooling market. It seems like it takes forever, and be patient because this could take a while, and the recovery will be faster, typically, almost always, than the period of the cooling. There's good news somewhere on the horizon. This is an updated version of a chart we've also shown before, which shows the dots show the year return and the lines show the range of returns during the year. So in every year, there was a negative return. Only 8 cases out of all returns going back to 1979 have a full year negative return. Could that happen this year? Yes, that's possible. We wouldn't be entirely surprised, but it might not be. But this is a great reminder that sometimes markets cool during the year and end up being positive before the end of the year. When encountering volatility, it's important to already have thought about how to use cash wisely. Now is not a good time to go to cash and hold cash as a safety tool for long-term money, because long-term that will not pay off. Cash is best used as a constant in advance for spending money that's on the horizon so that it's not subject to volatility. This is something we've talked with clients about and we've had in this quarterly context presentation for several years as reminders during a period when market valuations were stretched, and we've been talking for quite a while about the high probability of some level of cooling, and now it's happening. We couldn't predict when, but that just is and will always be a normal part of market cycles. So the key message here is use cash for your near-term needs so that it's not subject to market volatility, and don't use cash for the long run because you will lose against inflation and you will give up a big opportunity cost, which may be important to supporting your life goals or your organization's spending needs. This is the chart that we used as part of that conversation for the last few years, reminding people that depending on the time frame, there's a different portfolio that might make sense. Some clients only have one portfolio. Some will have a long-term portfolio and a combination or one short-term portfolio, depending on the size and nature of their spending needs. But when there is significant spending on the horizon, more than maybe just normal spending, or when there is whatever money is expected to be spent in the next year, it's a good idea to carve that out and have it in something short-term, ready to spend, not subject to volatility. And that's, again, especially important where you have big spending where there's a specific dollar value that you need, and having that money cool and shrink would harm your plans, whether you're an individual, a family, or an endowment. These are concepts that apply across the board. It's also helpful when there's volatility to remember that there have been many crises of different sorts in the past, sometimes where people panicked or thought the world was coming to an end or thought that we wouldn't make it through either as a country or as a globe, whether it was political or Cold War or a currency crisis or a global financial crisis or a major depression or an oil embargo, or the history's worst pandemic. A lot of big bad things happen, and one way or another, one of the amazing things about the human race is that we are resilient and keep pushing forward. It can be uncomfortable, it can be painful, it can take a while, but in the long run, that focus and discipline pays off. And we would say making a long bet on humans is a better idea than assuming that people and cultures and countries will fail entirely, suddenly, across the board, permanently. Another key element that helps control volatility to some degree, in addition to having a stock bond mix that makes sense for your particular needs and strategy, is rebalancing. Rebalancing is the idea of trimming what has grown and adding to what has shrunk in the short run to keep your stock bond mix in check, close to your targeted stock bond mix. You can see here a 60-40 portfolio in 1997 was a 35-65 if it wasn't rebalanced in 10 years later, and was a 52-48 portfolio just 2 years later than that. And 7 years after that would have been only 31% bonds and 69% stocks, which is a dramatically, about 10% higher exposure to stocks than intended. And that may be fun while the market's rising, but creates extra downside when it cools. However, that doesn't mean that led to better returns. Here on this side, you can see over that same time period, the return was higher for portfolios that were rebalanced regularly, and the risk was actually lower. So this is something we do for clients systematically over time, and this helps control risk. And if you are doing it on your own, and don't do that, you run the risk of increasing your downside and harming your long-term return. So that is the bulk of the presentation today. We have some new blog posts that you may find interesting and helpful, both on the personal wealth side and the endowment side, and we have a few coming out for retirement plans as well soon. And we always appreciate you joining us. It's an honor to work with you, and we're always happy to help others that we can help, like we help you. If you have organizations or individuals you think we should speak with, we always appreciate that. And then we have a few extra slides for those that want to hop off now. We'll just whip through quite quickly for part 2. Talked a little bit about this cash dynamic. Different vehicles can be helpful and cash returns are higher. There are normal business cycles that occur, and that is always changing. We talked about the capital market projections and the range of risk and range of returns last quarter. So current returns, even through so far in 2025, are all within normal expectations. This is the process that we use to help clients across the board in different ways for each type of client, but this is the high-level process. And even institutional investors are subject, according to the studies here, to emotional investing mistakes. And so using a process is just as valuable as it is for personal wealth individuals as well as institutions.